So you finally started getting income in your bank account and now you want to invest, but you're thinking stocks versus mutual funds. Which is the best route to go and how much to invest in each? Today, I will be solving this doubt for you. Hello everyone, I'm Shalini Gera, certified financial planner, and I welcome you to yet another school of thought. Before jumping into the stocks versus mutual fund bandwagon altogether and how much to invest, let's first understand what are the pros and cons of each and every asset class so that you can take an informed decision for yourself. First of all, let's talk about mutual funds. Mutual funds allow you to pick up between large cap, mid cap, small cap, flexi cap, focus cap, you name it, and that category is there. Secondly, mutual funds have a professional fund management attached to them. So when you don't know what are the right stocks for you, you can rely upon the fund manager. The fund manager has umpteen amount of experience in the security market and has the wisdom and the experience to choose the right securities for you, justifying your financial goal. Thirdly, mutual funds will also allow you to save tax. Did you know that you can invest up to 1.5 lakh rupees in mutual funds in equity linked savings schemes and save up to 45,000 rupees per annum on your taxes? Stocks will not allow you to do so. Fourthly, mutual funds will also allow you to hold extremely expensive share into your investment portfolio. For example, Apple is priced at $221, that is approximately 18,000 rupees. So you may not have this kind of money to invest into one Apple share. Even if you have 10,000 rupees, you can buy a global mutual fund and you will automatically have units allocated for the global mutual funds, which will allow the replication of the growth story of Apple directly into your investment portfolio. Next, mutual funds encourage you to have discipline. How? Monthly, if you automate your investments in the form of an SIP, your bank account will directly get debited and the requisite unit of the mutual funds will get credited into your bank account no matter what the market conditions are like. Finally, you can diversify, that is, you can hold between 30 to 100 different securities from each and every mutual fund. Even if 2 or 3 of the companies are not performing well or are laggards, then the remaining companies, chances are very, very bright that the remaining companies will be able to compensate for the negative performance of those 1 or 2 companies, thus giving you the effect of diversification. So when you don't know what are the right kinds of stocks to choose from, mutual funds become the best bet. अब advantages है तो disadvantages भी होंगे. For mutual funds, the biggest disadvantage is its expense ratio. You have to pay an expense between 0.5% to 2.75% to the asset management company for managing your funds for you. Another disadvantage of mutual funds is that they will not be in a position to deliver double or triple digit returns very quickly to you, which stocks can. This is because most mutual funds will aim for diversification in a number of securities, and the large number of securities will go for a risk reduction and hence the return reduction as well. Would you like stocks too? So let's also understand the advantages of holding a stock portfolio. Firstly, individual stocks with a high amount of momentum can quickly give you double and triple digit returns as well, which may not be possible for a mutual fund portfolio to replicate. For example, Hindustan Aeronautics Limited delivered a staggering 153% return over the past 1 year, which looks like impossible for any mutual fund portfolio to deliver. Secondly, in a stock portfolio, there is no expense management fee that you have to pay to a company, unlike a mutual fund portfolio. Yes, of course, brokerages are there, but the brokerage percentage is much less as compared to the expense ratio of mutual funds. Dividends. Dividends are nothing but the distribution of the profitability of the company to its shareholders. When a company generates profitability, it can either choose to plow back that profitability back into the company by expenditure, such as recruitment of individuals, or for that matter, acquiring additional plants and machinery. Or it can also choose to give this profitability back to the shareholders as a loyalty benefit. So by having a stock portfolio, you can generate a passive income in the form of dividends. You would have definitely noticed that if you are holding a stock portfolio, you have a certain amount of income hitting into your bank account every month given by the company. This is nothing but the dividend of the company. Of course, dividend is taxable, but it can definitely help you in generation of a passive income. For stocks, the biggest disadvantage is that there is no professional fund management. You yourself are responsible for selection of the right set of stocks in your own portfolio. There is no professional stock management involved for your stocks portfolio, unless, of course, you decide to go for an RIA or a PMS service. Now that we have understood what are the pros and cons of holding mutual funds as well as stocks in your portfolio, let's understand which of these you should be investing into at what point of time and in what proportion as well. Firstly, if you are a beginner, that is, you've recently got a job and you have a small investable surplus available to you in the form of your salary, you should definitely automate maximum amount. I would suggest 90% of these investments in the form of an SIP. With the 10% of the remaining surplus, start a stock portfolio for yourself. The rationale is that at this stage, you would not have too much of an experience as well as knowledge to select the right kind of stocks. So having a professional fund management in the form of a mutual fund asset management company will give you the advantage of selecting the right kinds of stocks at the right point of time. The fund manager will buy the requisite amount of stocks which are going to generate profitability in the long term, and will then send off the stocks which have already generated profits, will book the profits and will deliver returns for you. Secondly, you can also utilize the knowledge as well as the experience that you are generating by having that 10% into stock portfolio in order to build a large stock portfolio later on in life. If you have larger lump sums available to you at this stage, it could be in the form of a signing bonus or it could be in the form of some kind of inheritance that you have obtained. You can use the services of a SEBI registered investment advisor who will understand your financial goals, your risk appetite, as well as your return expectations in order to create a customized financial portfolio for you. Stage 2. Now that you are an intermediate investor, you have generated some knowledge as well as some experience by investing in the equity markets. Secondly, you also have certain amount of midterm as well as long-term financial goals, could be in the form of a marriage or for that matter, building a children education fund or getting a house or a car. This is the time to start putting in a larger amount of surplus in an equity portfolio. At this point of time, I would suggest investing between 50% to 75% of your investable surplus in an equity portfolio. This will enable you to build a much larger corpus over the remaining period of time that you are investing. This will also help you to utilize the experience that you have generated in the beginning stages in order to buy stocks for yourself. For example, in the earlier stages of your investments, you would have understood that it is important to buy during dips. This will help you to buy stock at lower prices, and when you sell them, you would be selling them at a higher price, thus maximizing your profitability. Remember that at this stage, when you are investing between 50% to 75% of your investable surplus directly into stocks, it is going to require a heavy amount of research, both fundamental as well as technical, in order to do the right stock selection. If you feel that you can give your personal finances this requisite amount of time as well as bandwidth, definitely do the research yourself and invest time and bandwidth into buying good quality stocks for yourself. If you feel that you are not in a position to give this kind of time, bandwidth, as well as knowledge to your own stock portfolio, then I would suggest that you invest in the services of a SEBI RI. The SEBI RI will charge a fee from you, but this fee is going to be justified because the financial advisor will understand your goals, your risk appetite, your return expectations, and then will create a customized portfolio for you in the long term. So this was our today's school of thought on investing in mutual funds versus stocks at what point of time. We hope and do believe that this added value to your financial content. Please do let us know on what other financial content would you want us to talk about. If you like this video, please do hit the subscribe button. Do let us know on what other financially relevant content would you want us to talk about. We will continue to deliver more such financially relevant content for you in the future. Till that time, you take care of yourself. Bye-bye.